Good day, listeners. Welcome to another edition of As a Matter of Tax. It is always a pleasure to have you with us as we continue to make tax matters clear, simple, and easy to understand. On today's program, we will be discussing reassessments and best of judgment assessments, commonly referred to as BOJ assessments. Here in St. Vincent and the Grenadines, our income tax system operates on a self-assessment basis. This means that each taxpayer is required to file an annual income tax return declaring the amount of income earned for the year and calculating the tax payable in accordance with the provisions of the Income Tax Act, Chapter 435. After a return is submitted, it may be reviewed by the Inland Revenue Department to determine whether the information provided accurately reflects the taxpayer's true financial position. Where the controller is not satisfied that the return is complete or accurate, the law allows the department to make adjustments and issue a reassessment. These adjustments may include 1. Increasing the taxpayer's assessment where income was omitted or understated. 2. Disallowing deductions or allowances that are not permitted under the law or are not supported by adequate records. 3. Reducing losses claimed. 4. Adjusting any credits or set-offs claimed for taxes previously paid. Additionally, where a taxpayer or company fails to submit a return, or where sufficient information has not been provided to determine the correct tax liability, the controller may issue an estimated assessment, commonly referred to as a best of judgment assessment. Under the Income Tax Act, the controller is authorized to make an assessment according to the best of his judgment where a person fails to furnish a return or fails to provide adequate information to determine the correct amount of tax payable. Taxpayers are reminded that failure to file returns or fully disclose income may result in the issuance of a best of judgment assessment, together with applicable penalties and interest. Where a taxpayer disagrees with an assessment issued by the department, the law provides for a formal review process. According to Section 101 of the Income Tax Act, Chapter 435, any person who is aggrieved by an assessment made by the controller may file a notice of objection within 30 days of the date of service of the notice of assessment. An objection must be in writing, clearly state the grounds for the objection, and be submitted to the controller within 30 days of the date the notice of assessment was served. After reviewing the objection, the controller will notify the taxpayer of the decision. If the taxpayer remains dissatisfied with the decision, they may appeal to the appeal commissioners within 30 days of the controller's determination. Taxpayers should note that filing an objection does not suspend the obligation to pay the tax due, and any undisputed portion of the liability should be settled promptly to avoid the accumulation of additional penalties and interests. Now, a reminder to owners and drivers of motor vehicles. All motorists are reminded that it is your responsibility to ensure that your vehicle license and insurance are kept current. Owners of motor vehicles with registration numbers ending in 4 are reminded that your next renewal period is April 2026. Persons celebrating birthdays in April are reminded that their driver's license must be renewed on or before their birthday. General reminders. The deadline for filing personal income tax returns and corporation tax returns for companies with a December year-end was March 31st. Outstanding returns may now be subject to penalties and interest. Companies with a January year-end are required to file their corporation tax returns by April 30th. All taxpayers are encouraged to remain compliant by filing accurate returns and ensuring that taxes are paid on time. That's all for today's edition of As a Matter of Tax. Join us next time as we continue to make tax matters clear and easy to understand. I am Trevor Grant. Thank you for listening and have a great day.